Hey, good morning, everybody, and welcome to this Tuesday, March 11th, 2025 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with all of you again this morning. Not so much pleasure to be in the stock market, though. I mean, the market got hit pretty good yesterday. Got a lot of issues out there we've talked about for weeks now. Don't really need to go into a whole lot of that. I think the market's very uncertain. We've got a big inflation report out tomorrow morning. That will be the February CPI. That's followed on Thursday by the February PPI. And then next week, Tuesday and Wednesday, we have the Fed meeting, which is during option expiration week. So it's going to be a crazy next, I'm going to say 10 days or so. I think the further we go down, I think the more likely we're going to have a big snapback rally next week with options expiring. I can only imagine right now how many in the money put premium or how much in the money put premium we have right now across the market, all individual stocks, sectors, major indices, and so forth. But it's too early to start trading based on options expiration next Friday. So just be aware of it. I mean, right now, I can only imagine, like I said, I haven't gone in to look individually at the options, but I can sense that it would be pretty skewed at this point towards the options or toward the put options. Anyhow, so we're starting the market off with a volatility index that up in the upper 20s. I don't even know if we hit 30 yesterday. I'm sure we'll take a look at that here in just a couple minutes. But you can see, taking a look at the action yesterday, and I'll make this just a little bigger here for you. Hopefully you can zoom in here. The Dow Jones Industrial Average down another 900 points. I mean, we're now down 41.9, which quite a distance away from that all-time high above 45,000. Not quite in the correction territory yet, but one of the benefits the Dow's been seeing on a relative basis is that it's home to more industrials and more value-oriented stocks that have not been hit as hard as many of the growth names and stocks that we tend to follow a lot here at Earnings Beats. So the Dow's kind of escaped some of it, but you can see still down 3,000 points, over 3,000 points from its recent high. S&P 500, I talked about, back in beginning of the year and more recently that I could see a 10% correction in the S&P 500. We were at 6144 or 6147, which would take us down to roughly the 5,500 level. And yesterday, we were actually in the 5,500s, as you can see right here on the right or left-hand side of your screen. We had dipped down into the 5,500s and came back up and held 5,600 at the close. But the S&P 500 took another tumble down almost 3%, 155 points. And we are now more than 500 points away from the all-time high. So S&P 500 continuing to drop, moving closer and closer to correction territory. Wouldn't take, much at this point. I think we're down maybe about 8.7% from the high. So another 1.3% or half of yesterday's losses, and we'll be there. NASDAQ down 728 points, 4% on the NASDAQ. The NASDAQ's now down, I think, over 13% since its high. So it's clearly into correction mode. And of course, the NASDAQ is home to many of those large cap growth names that have been hit so hard. Many of the growth names, period, have been hit so hard, but especially the large cap that many of you follow, many of you trade, many of you own. I think long term, they'll be fine. Short term, not so much. I mean, this is a market that's under a lot of pressure. The growth area is under a lot of pressure. And when the VIX is up in the 20s, upper 20s, on the border, on the verge of going into the 30s, it can get pretty scary. Still looking for that capitulation. Yesterday had a little bit of it. We're seeing that volume really pick up, but I want to see that big surge in the VIX with a big reversal, and haven't really seen that yet. I like to see like a long tail to the top where it looks like things, intraday are just absolutely falling apart. Nobody wants to be in the market anymore. We want to see the sentiment on the option side really start to move to the upside. And I think when we get a little bit more of that, we can start talking about a bottom. I think it's too early. This could be an ABC type of move to the downside where we're still in the A move to the downside. Maybe that B is coming. We should be seeing some relief. We should be seeing some relief pretty soon. But whether or not it's today, tomorrow, next week, really difficult to tell. And you can see that the losses are getting bigger and bigger as the VIX climbs higher and higher. And this is one of the things that we talk about. When that VIX gets above 20, not good thing. Good things generally don't happen. I mean, we can top with a VIX in the low 20s, but the risk of holding when the VIX is up into the 20s, you have to ask yourself if it's worth it. And I think you can see recently that it hasn't been worth it. Now, most of what I'm talking about is from a short-term trading perspective. I am still of the opinion at this point that we're fine. We're in a secular bull market. We're going to go through this correction, possibly, throw it out there, possibly a cyclical bear market, which would be a 20% drop. I mean, the Russell 2000 is basically there. It's right on the cusp. The NASDAQ down 13%. Wouldn't take a whole lot for that to get there. Still would be quite a bit of selling, quite a bit more selling on the S&P. The one thing that's really holding up the S&P and the Dow is the value side of the market, the dividend payers, the defensive names, consumer staples trying to make breakouts to all-time highs. We've seen real estate and utilities doing better. Those three groups, by the way, their tendency is to outperform during the month of March. So maybe the extent of the selling that we're seeing is a little unusual, but the leadership is not. This is typical in the third month of many calendar quarters. March, June, September, those three in particular, even December, tend to favor the defensive value, dividend paying type stocks. That's generally what benefits once we get through earnings season and all of that excitement slows down in growth stocks. This time it's just a little bit, maybe it's on steroids a little bit. And I think a lot of that's based on some of the warning signs that we've been talking about for a while. So anyhow, that's where we are right now. Not good. Very difficult to want to just jump back in as a short-term trader on the long side. Now you might say, well, why don't you just short? Well, good point. My problem is I don't like to short during secular bull markets. And I still believe we're in a secular bull market. I would rather be in cash in my trading accounts and simply let the market fall and my buying power goes up. So that when I feel a little bit more comfortable, or if I want to take a shot on the trading side, I can get in cheaper. And so that's kind of my philosophy until I feel like a bottom is in. And then usually when I feel like a bottom is in, what I'll do is if I'm going to get in the market, like if I were to trade today, I would almost certainly buy an ETF. Individual stocks, yeah, they're great if you catch a bottom. Some of them can rip back to the upside 10, 20% pretty quickly. But the problem is those are the same stocks that get hammered if you come in a little bit too soon. And so then, say you're getting in, you think market's oversold, it's going to bounce. What do you do if you jump in and midway through the day, the S&P is down 3%? Some of the stocks you have are down 8, 10, 15%. That's a big hit to take in your portfolio. So like I've said before, like I'll continue to say, I despise trading a high volatility market. I want the VIX at 11, 10, 9. Some will say, well, that's where market tops form. Ultimately, that can happen, but the market can trade with a low VIX for a long time. And those for me are the best markets. Because I don't feel like I'm going to wake up to something in the morning, be down 3%, 5%, whatever. I don't feel like I'm going to get a bunch of impulsive selling during the day where the market makers essentially go on vacation and, let all the traders fend for themselves. Everybody wants to sell when the market gets really weak and gets highly volatile. And you just don't have individuals willing to put up the capital. Individuals are fearful. They're scared. They're not going to buy in the midst of this huge sell-off. You've got to have institutions willing to do it. And when the market makers go on vacation, VIX gets high. That's when we see drops similar to what we saw yesterday. So, hey, I wish I could change things. I mean, the market is what it is, and we have to deal with it until we get through this period of volatility. Some of you might think, oh, this is a start of something huge to the downside. This is, everybody's entitled to their opinion. I don't believe that's the case. But I don't like some of the recent developments. I can tell you that. The US, for instance, which has been the place to be in terms of investing for the last 10, 15 years, especially the last 10, starting to, back off. We're starting to see other investments, foreign investments that are doing much better. Stock markets around the globe outperforming the S&P and have been doing so now for the past few months in some cases. So starting to see a little change there. And so maybe putting a little bit more, weighting a little bit more toward the international equities, that makes some sense to me, given what we've been seeing. All right, let's take a look at the sectors and what happened yesterday, just yesterday. And so the market did try to come back a little bit, but it was way, way, way too late. Market had already taken a huge drop. Sometimes we see those big drops where we're down 3, 4%, 5% during the day, and we come back and recover all those losses, finish strong. We see money rotating back into a lot of the aggressive areas. Those can be capitulatory type days, bottoming kinds of days. I don't know that we saw that just yet. Yesterday, we did see a rally at the end of the day. I saw futures earlier, just a little while ago, were up. But let me hold on one second. I will give you the latest. So it's taking me a little while on the other computer. There we go. Right now, we got 18 minutes till the market open. The diamonds are actually down 0.1%. Everything was up earlier. The S&P 500 is down just less than 0.1%. The QQQ, NASDAQ, up about 0.1%. NASDAQ was up, I want to say close to 1% earlier this morning. Maybe it was 0.75%, 0.8%. And then small caps still up close to 0.5%, but that's down quite a bit. Small caps were up more than 1% earlier. So definitely futures coming back down a little bit. And we still have 18 minutes to go. So we could start off in the red across the board. We'll see. But my point is here, yesterday's leadership, all were defensive. Utilities, energy more neutral. I like to call neutral. Consumer staples, real estate, healthcare. I mean, there are your four defensive groups along with energy. And then you've got industrials outpacing materials, but materials would be that other neutral. And then essentially you've got all the aggressive groups down at the bottom taking massive hits. Technology down 4.25%. Consumer discretionary. Look at the difference between consumer discretionary and consumer staples. It is just continuing to just get wider and wider and wider, the disparity recently in performance. Consumer staples absolutely crushing discretionary. This, to me, is the signs of a weakening economy. I mean, or an anticipation of a weakening economy. Either way, it's not good for the stock market. I'm seeing the same thing with the 10-year Treasury yield, which has been coming down. Let me see where we are right now on the 10-year. We're up to today 2 basis points, but we're at 4.23%. Recently, 2 months ago, we're at 4.8%. So the fact that the yield's coming down, these last 2 months, the sell-off, it's occurring with what I believe is the market reacting to weakening economic conditions, not inflation. Again, if it were inflation, we'd see the 10-year Treasury yield rising considerably. We'd probably be back up to 5% or above. Instead, we're seeing the yield come down, which means when the yield comes down, means bond prices are going up. Folks are buying bonds. You don't buy a 4.25% 10-year Treasury bond if you believe that the inflation is going to go back up. It makes no sense. So from a common sense perspective, the yield is likely coming down due to concerns about the economy. And if that's the case, inflation is going to take care of itself. I mean, you're going to have weakening demand. I mean, the whole idea with inflation is you get, runaway inflation when you have too much demand versus supply. And in this case, I think we've got the opposite, which should bring down inflation by itself. And maybe that's the Fed's goal. Maybe the Fed's goal was to slow demand enough to the point where they don't have to worry about inflation. And if that's their goal, they're doing a great job, because the market's telling me that we got economic problems. Anyhow, let's keep moving. Take a look at the S&P 500. Here is the drop. I was thinking on the way down that maybe we would stop around this 5,800 level, bounce to the moving averages, and then kind of fall back. So I was thinking, maybe this would be some sort of a neckline around, this bottom 57.80 or so. We went right through that. We did take a little bit of a bounce one day, and I thought, okay, here we go. Got a little bounce. We're going to get that right shoulder in. Never happened. One day of strength, gap down, right back down to the lows. And then I thought, well, this 5,700 area would be a nice area for maybe a reversal. And so on Friday of last week, we got down 5,600 and change, came back up, closed above 5,700. I said, great, here's the neckline. There's kind of almost like a double head on the head and shoulders pattern. Here's the left side of the neckline. Here's the right side of the neckline. We reversed off of it. I thought going in to Monday, we might have a shot, at least an increased chance of move back up to those moving averages. And yet what happened? We gapped down, market sold off all day. So we still haven't really had much of a move back to the upside, which tells me that maybe we're not going to see any kind of head and shoulder type of top. And it makes me think, okay, let's take a look at the weekly chart and see what the weekly chart is telling us. Well, this could be, we're in the middle of the week, it's Tuesday. We could go down below the 50-day moving average and then come right back up, or maybe we come back up next week, and it could look a little bit like the bottom that we saw in the correction of 2023. That summer of 2023, where we went down 10%. It kind of looks a little bit like that right now. One thing I would say that's different is the massive volume that's coming in. I mean, keep in mind that prices are a lot higher than they were back in 2023. So even equal volume would be more dollars because prices are higher now. But this is actually much higher. I mean, this is a lot of selling taking place. I mean, I don't want to sugarcoat this. When I talked about a correction, I thought maybe it was just going to be, ABC correction, get through the first quarter, and then maybe into the early part of the second quarter, kind of start regrouping, and then make a run in the fourth quarter again to all-time highs. That may still work. But we do have signs suggesting that it might be worse than just a correction. The volume is one part of it. We're seeing a lot of mass exodus right now away from growth stocks. And if that continues, or if on a bounce, we don't really see that group coming back strong, then I think we got bigger problems ahead. So right now, I'm just waiting for that bounce so that we can kind of gauge the strength of it. If it's just a little bit of a weak bounce back toward the 50, where we're really not seeing a lot of outperformance in other areas, we're not seeing accumulation in some of the areas that are more aggressive, that would indicate that maybe we're moving back toward a risk-on environment, then I think we've got to be real careful here. So again, I'd like to be the bearer of good news, but I call what I see. Even though I've been very bullish, I've been pretty much a bull since 2013, really, since we broke out of that double top on the S&P 500 around the 1550, 1570 area. Ever since we broke that out, or broke out above that, I've kind of maintained this long-term secular bull market mentality, which I still have, but we go through periods of weakness and we try to call those as best we can. I think we've done a really good job of that, including the one we're in right now. But as we go down, you have to evaluate. You have to continue. You can't just say, okay, it's going to be a correction. We hit the correction. Okay, now everybody back in. You got to look at what happens during the correction, during the recovery process. It's a process. It's not make the call at the beginning of the year and, oh, that's just going to last. So we need to see what happens from here in order to make a more definitive call going down the road. I would say that the odds of this morphing into a cyclical bear market at this point on the S&P 500, obviously much higher than it was back at the beginning of the year. But I don't think that's a slam dunk. Again, I want to see this rally, the first rally we have, and see what kind of strength we see. And then the next pullback might be a little bit more palatable. It may not be as much toward the growth stocks. It might be defensive stocks that are coming down with the growth stocks. Maybe the growth stocks actually hold prior lows and defensive stocks weigh on the market. And then that relationship between growth and value starts to flip. That would be positive. Anyhow, I'm doing a lot of projection here. We've got to see it all unfold and then kind of look from there. But right now, I think caution remains the word, especially I'm going to pull up that VIX. You know, when you see this VIX rising and it's, you know, yesterday got a high of 29.56. I mean, we saw what happened in August when we went back, you know, went up through that 30 level and went to 40, 50, 60. I mean, the IWM small caps lost 15% in 2 days. 2 days and maybe a fraction of a third day, from what I recall. I think we had a Fed meeting, policy statement came out on a Wednesday, and then trying to piece back together when it was. I think it was July 30th and 31st, or maybe it was 31st and the 1st of August. 29th was a Monday, Tuesday. No, it was the 30th, 31st. And so on Thursday, that's when I wrote to our members and I said, hey, we got some problems here. And that was in the morning. And that was right before the VIX went from 17 to 65 in about 2 days. And so I wrote to everybody on that Thursday morning and I said, I'm getting out. I said, I don't like what's setting up here. And then over the next 2 or 3 days, that's when we saw the market absolutely collapse. And the small caps, the IWM, literally, I think went down like $30, 227 to 197. I guess we could pull it up and take a look. 227 to 197. So right here, that was this huge drop that we saw. And look at where we were at the end, right after the this would have been, we would have been setting this high. It was a false breakout on the Wednesday of the Fed meeting. And then Thursday morning is when I sent out the email to members and I said, this doesn't look good. I think we're in position for a much larger drop. I think maybe we were already down to about 217, 218 on the IWM at that point. But literally by Monday morning, this was Thursday morning, by Monday morning, you can see that massive drop. And the IWM was hit the hardest. But then we also had the QQQ. If you look at that back then, you could see massive drop. Spider, same thing. So, but most of it was gap downs. It wasn't distribution. It wasn't selling throughout the day. In this case, we've seen a little bit more selling, although we've had some pretty good days in here where we closed near the highs. But we're going to need a lot more of those types of days. Gap downs followed by some buying, or morning selling followed by some afternoon buying. Those are the kinds of things I'd be looking for to make me feel better. Even though we might be going lower, it would make me feel better about a bottom approaching. Another thing I think that's important we want to talk about here is the CPCE. This is the equity only put call ratio. And I'm just trying to get something set up here for later. Hold on, before I forget, before the market opens. I'm trying to track the hourly equity only put call ratio. And so I wanted to make sure I got that up on a screen because when we start getting into this, you know, I've got a method to my madness. And so when we get into a really emotional market that's being driven a lot by sentiment and fear, I like to start zeroing in on the equity only put call ratio during the day, not just the daily readings, but then the hourly or half hourly readings as well. So anyway, I just wanted to make sure I had that set up before the CBO changes and starts moving into today's action. I can go I can do a screenshot. Anyway, aside from that, I mean, look at where we are on the equity only put call ratio. Did you see all the selling that I saw yesterday? The equity only put call ratio at 0.60. Are you kidding me? That's it. Usually we should, on a day like yesterday where there's just selling all day long and you would expect fear to be building, and the equity only put call ratio is still sitting much closer to what you would expect would be a very complacent market where the market just keeps going up. That's usually when you see readings at 0.60 or lower. Normally, when you see markets selling off like we saw yesterday, the equity only put call ratio, I would have expected yesterday's reading to be up to 0.75 or above, starting to show some fear. It's not showing up in the options market. So, yeah, volatility, the market makers are telling us, hey, you got to be careful because they're the ones that price the premium on options. And that's what goes into the actual calculation of the VIX. So I like using both these sentiment indicators because, as far as I'm concerned, the volatility index gives me kind of the sentiment reading based on market makers and what they see. And trust me, I like to follow the market makers more than I like to follow individual traders. Individual traders are still treating this, even though we're down 8%. I heard somebody the other day, might have been somebody responding to me on one of my videos, saying that, everyone is bearish. Everyone is bearish. Uh, Retail traders aren't. I can tell you that right now, just based on the money. I mean, the equity only put call ratio, 0.6 yesterday. NASDAQ was down 4%. Options are getting killed. You would think folks would be switching over to the puts at some point. But according to this, and by the way, we're still going to have an issue next week with options expiration, even if there's still a lot more calls being bought, because as prices drop, all those calls become worthless or they start dropping in value. It's all the puts that, even if there's less puts than what I think should be out there, there's still going to be a whole lot of puts out there that are continually gaining value. So we're going to have a lot of net in the money put premium by the time all this unfolds next week if we don't get a rally. If this thing keeps going down day after day, first of all, the losses are going to start to accelerate when you've got VIX. And we saw that yesterday. Again, S&P down 2.7%, NASDAQ down 4%. Those are big drops. And those are the types of drops we see when the volatility index is elevated and above 20 and rising. Now on the verge of going into the 30s. I mean, don't rule out the possibility that we're going to see the S&P 500 down 5% one day. It could happen, especially again with the volatility index as high as it is. And it may need to happen to get options traders, to get the retail traders to finally say uncle and switch and start looking at this as a much more bearish market. And so this is a problem still for the bulls as far as I'm concerned. There's not enough bearishness out there to mark a bottom. Once the retail traders start to turn more bearish, then I think we got something to work with. But anyhow, and that doesn't mean that we have to go up before the market bottoms. I'm not saying that. This is just one signal, and it's one secondary signal. Price action, what happens on the S&P 500 chart, the NASDAQ chart, that's the primary signal. Get a big reversal like we had on Friday. I would think that we're going to reverse, start to move back up. Didn't work because nothing works 100% of the time. But I'm going to look at those signals as my primary signals. I'm going to be looking at the VIX, the equity only put call ratio, the rotation between offense and defense. All of those things are going to be more secondary indicators. It's just that they all kind of are coming together at the same time. And if we go back and we look at, say, the S&P 500, here's the daily chart. But if we go to that weekly chart, I mean, look, as we keep going up, how we keep coming down. And now we're getting close to a reset finally. That's good. I mean, look at what happened back in 2021. Now, this was before we had a cyclical bear market, but we had the same kind of configuration. The difference was we actually went through the center line and continued to show more and more bearish momentum to the downside. What I look for with a negative divergence is a reset at the zero line. Doesn't mean that we're going to keep going lower. So by price action coming down, we are actually resetting the PPO, which is a good thing. We can finally move on when the market does finally start to turn higher. We don't have to worry about a negative divergence anymore. Once we reset, I don't care what happened back here anymore. That's gone. eliminated. Market did what it needed to do. It rinsed out, wound down all of that, waning buying momentum that we had. It's now been reset when we get to that zero line, and getting to the 50 period SMA as well, I think is a good thing. Now, I'm going to give you the bear case. I'm going to give you the cyclical bear market case, and if we were to actually hit 20%, I think the top that we saw back in 2021 going into the bear market, cyclical bear market, we broke out. That was right around 4,800, and we've never been back there. So do I think that it's possible in an extreme high volatility market, we go up to the 30s, 40s, 50s, that the market could quickly accelerate selling and really create fear in this market? Could we hit 4,800? Yes. That's not what I was calling for at the beginning of the year. But looking at what I'm looking at, seeing the VIX elevated, still no real fear showing up in the options world. I would have thought there had been pretty good fear by this point. Small caps down almost 20%, NASDAQ 13%, S&P almost 9%. And yet options traders are still looking at this the way they have during the entire uptrend. I don't get it, but we might need that flip. We might need retail traders to finally throw in the towel saying this is the worst market ever. We're going to zero and I'll never touch the market again. That'll create a bottom. So continue to watch this, but this is why for me, it's so dangerous with a VIX in the upper 20s to just say, okay, we've gotten a nice pullback. Let's throw our money back in. I'm just not seeing enough signs to give me that warm and fuzzy to do that just yet. Now, options expiring next week. I do think there's going to be a trading opportunity on the long side. If not this week, if we keep going down, I think next week, maybe we just get a relief rally after the Fed's done, or maybe the Fed says something on Wednesday that says, hey, the economy is really, beginning to slow. And keep in mind, the stock market's the best economic indicator of all. So if that starts tumbling, that's going to give the Fed a clue as well, just like new home sales or any other economic report out there. So if the market continues to fall going into that Fed meeting, I think the Fed may change its tune a little bit and maybe just say, hey, we're continuing to watch the data, but we believe that this is going to help alleviate some of the inflation concerns. So anyway, all of that's a possibility. I just saw it's just after 9:30. So try to get through the rest of this here in just a minute. I thought it was really important just to talk about the overall market rather than get into individual stocks and so far. That just doesn't make sense for me at this point. Again, like I said, if I decide to take a position, it's going to be ETFs. It's going to be the SPDR. It's going to be the QQQ. Could be the IWM, but I'm not sure I'm ready to go there just yet. I think we really need to see more indication that rates are going to come down. We're not quite there, and that's why that group, unfortunately, has underperformed during this period of weakness. But individual stocks are just riskier. That's all. If you want to do it, that's great, but just make sure you're up for that risky challenge. All right. So anyway, if we got back to 4,800, I'd be very surprised, and I think the market at that point, we'd see a lot more pessimism, and I think we'd see a reversal that would mark a major bottom at 4,800. I do not think that this is going to start something where we go back down to the prior lows of 3,500, anything like that. I would be saying for me, worst case scenario at this point would be 4,800. I'm still thinking more like 52 to 54. Again, it's just more of an educated guess. Need to see how the market performs from here, how we rally, the makeup of the rally, the makeup of the next leg lower. I mean, all of that factors in. Let me just give you one more thing before we wrap all of this up. I do want to take you over to Earnings Beats real quick. Those of you who are new to Earnings Beats and our channel here on YouTube, if you go over to our website at earningsbeats.com, you can start a free 30-day no-cost trial. That will require a credit card, but you won't be charged. And we'll get back to you before your 30 days is up to let you know that, hey, you're expiring. What do you want to do? So we're not just going to let it go in 30 days and charge you at that point. We want to make sure that you like the service, that you're getting something out of the service, that we provide you value. And then you can make a decision on whether you don't want to stay as a monthly member or an annual member. We always give special deals to our annual members, save a lot of money, sometimes up to 50% off of a monthly membership. Anyhow, also want to mention this is our free education week. So you can come into our website, click on this. We had our first session yesterday talking about a couple of our chart lists, our strong earnings chart list and our raised guidance chart list. Today at 5:30, we're going to be talking about our strong AD chart list, accumulation distribution, not advanced decline. Some people, I say AD line and they think it's the advanced decline. That's not it. Talking about accumulation distribution line. Companies that have strong AD lines tend to be companies that are bought later in the day, tend to finish stronger. And so they can be great trades when they're down in the morning, coming back. I'm going to show you how we put together our strong AD chart list, which probably has, 300 companies in it. And then also we'll talk about our bullish trifecta chart list, which is a really unique chart list. It houses what I think are maybe some of the best stocks out there. There are only 39 stocks on this list. So you might want to stop by, check it out. Also, we're going to be giving away these chart lists for free to anybody who comes in and checks out these videos. So anyhow, just want to mention you can register for that by clicking on that free education week register now button. Come join us tonight on YouTube at 5:30. That would be awesome. And for those of you that are on mobile device, we have a screen that's up where you can just simply scan on that QR code. And that will take you on your mobile device to a landing page where you can sign up for this free event or free events. We're going to be doing this tomorrow, Wednesday, and Thursday, all of them 5:30 p.m. Eastern Standard Time. Also, make sure you like this video. That will help us. That's actually something you can do to help us. It's completely free. Takes 1 second. Just click on that like button and subscribe to the channel, because when we do these free live stream events, you'll be notified every time we do one. So make sure you subscribe to the channel as well. All right, market is open. Let's see what we got. I'm always afraid at this point. We got a little mixture. We got the Dow down 165 and the NASDAQ up 80, which tells me right off the bat that maybe we're seeing a little bit of a shift, even if it's just temporarily, toward growth stocks. We need to see that continue for quite a while. VIX is up though, which is, the S&P is down. Obviously the Dow's down, but the VIX right now, 28.21. I'm telling you, if that VIX gets into the 30s and starts to accelerate, it's not going to be good on the long side. We don't know if we're reversing here just yet or not. Just be careful. I've been trying to say that really for the last couple months. Sometimes it doesn't resonate when the market's still sitting at an all-time high, but now you can see why. We talked about being cautious. Some of the signals that were out there telling us that exactly this could happen, a correction. Maybe it's worse. But this is why we do what we do. So if you're not a member, come join us, learn more about how we gauge the market and how we put this stuff together. Anyhow, have a great rest of your day, everybody, and good luck out there. Be safe, and maybe we'll get a better market ahead. Happy trading.